I used $80,000 of the equity in my first investment property to use as a deposit for the purchase of my second property. And today I'm going to explain how this was possible and how it works. Welcome back to my channel. My name is Reese, and in today's video, I'm going to be talking about what home equity is and how it can be used as a tool to help further build your wealth. Home equity, in its simplest terms, is a property's current actual market value minus any debts that are attached to that property, such as a mortgage. I purchased my first property when I was 24 years old. Now, including all of the costs associated with that purchase, I paid a total of $450,000 on the dot, and I put $100,000 towards that purchase, or 22% of the total purchase price, to avoid LMI. So just as a bit of context of when I used the equity in my first property to put towards the purchase of my second property. At the time, property number one, my investment property, was valued at $500,000 and I owed $320,000 of it. If you work out the equity using the equation I just mentioned a bit earlier, I had $180,000 of equity. Now, I didn't want to borrow that full $180,000 because that would put me above the 80% LVR ratio, and I didn't want to be above 80% because then I would have to pay what's known as lender's mortgage insurance to the bank. So I borrowed all the way up to 80%, which gave me $80,000 worth of money to put towards my deposit for this second purchase. I purchased this second property with my partner, where after all of the fees, it cost us $913,000. So with this second purchase, to form the deposit for this property, we came up with $120,000 of our cold hard cash savings, and then added a further $80,000 from the equity of my other property to make a really strong deposit for this purchase to again avoid paying LMI, or lender's mortgage insurance. It also balanced out the loans between the two properties. Doing this also allowed me to keep more liquid cash in my offset account, which means I didn't have to watch that money go and get locked up in the loan, not really being useful if I ever needed access to it. Now, out of that little story of context, there may have been some things that might have been confusing to my viewers, which I don't blame you. Financial topics are relatively complex from time to time, but they're not that overwhelming to learn about. So if you don't know what LMI is, being lender's mortgage insurance, if you don't know what LVR is, being the loan to value ratio, if you don't know what offset bank accounts are, these are all topics that I have made videos on discussing them in depth, and I've left links in the description down below to some useful videos that will help explain what these things are, because understanding them can really help you in the world of buying property and selling property. It's worth understanding. So feel free to use them as you wish. They are down in the description below. And now would be a really good time to just quickly hit that like and subscribe button if you haven't already. It really does help the channel grow. I really do appreciate the support, and it does not go unnoticed. So thank you for taking the time out of your day to do that for me quickly. Now, using the equity in my investment property to put towards the purchase of my second property was very helpful, no doubt about it. However, there are some risks that are worth going through, and I think that this is the forum to do that. So let's go through them one by one and just talk a bit more about it, just to bring awareness to what kind of things could go wrong in these scenarios. Number one is that bank appraisals don't really mean anything at all. There is no guarantee that you are going to be able to sell your house or your property for the value that they are telling you it's worth. In the instance of my first property, it was valued at $500,000, but there was no guarantee that I would have got that amount of money. I might have got more or less, but that is just an appraisal based on how they calculate how much equity you have in your house. Essentially meaning that I was borrowing money with the idea that my collateral, being my first investment property, that's the collateral. If I had to sell that house to pay it off, plus use the money from that sale to inject it into the second loan, that it would sell for more than what I actually owe on it. Being, if I owed $400,000 on it, I would need to sell it for more than $400,000 for my collateral to hold up. And this is where using equity to purchase another property can become very risky. Because I do the calculations and I understand the math, it was a really good move for these first two properties. However, this can be repeated technically, so it becomes a little bit more complicated if I wanted to build an asset portfolio by doing this over again and again and again. Let's use my own scenario as the example because it's the most relevant piece of information I have for this video today. based on the feedback from my lender, I'm actually able to borrow another $700,000 on top of my current existing debt, with a combination of my own cold hard cash being my savings and the equity now I have in both of these properties. With that kind of borrowing potential, I would be able to purchase a third property, and as long as all three of them are rented out, I would be able to service that debt relatively comfortable, even though my debt would be quite substantial. It would be well over the $1 million mark and almost into the $2 million mark. Where it starts to get scary in this scenario is that I am now relying on this system to work for me constantly. I need to manage these properties and make sure that that income stream does not stop. And this is where greed can be a real killer, as this strategy can effectively be used many times over to borrow large sums of money to build an asset portfolio worth of properties. The risk comes into play where if these assets do not appreciate over time and instead don't appreciate, you're still stuck with that debt and you don't have an asset that you can just sell off at any given time to pay those debts off. This is where it becomes very, very risky. The hope within this strategy is that the properties will appreciate over time, allowing inflation to eat that debt, making them a good investment and a good hedge against inflation. Where, like I just mentioned, if interest rates rise too quickly, that debt very quickly becomes unserviceable and people really start to squirm. Where if I defaulted on paying my mortgage, the banks would then be able to take my collateral and liquidate them to pay my debts. This is what we saw happening back in the 2008 global financial crisis, and currently there are a lot of headlines making their way into the tabloids which are fear-mongering and really starting to scare some people because they may have borrowed too much money, making it a very hard time for them, because if interest rates do rise quickly or the housing market is in a bubble and it pops, it's going to put a lot of people into financial hardship, and it's going to put a lot of stress on these families, which isn't a good thing whatsoever, because the flow-on effects then flow into the economy, which that is a topic for another video. Just quickly touching on it, if interest rates rise too quickly to combat inflation and wage growth does not follow, I do see this being a reality for some, but not necessarily everyone. I do believe we will see some people default on their mortgages if interest rates rise too quickly. If you're interested in following that type of story, I've actually talked a bit more about it in my topic on liar loans, and I've linked it down in the description below as well. Feel free to give that video a watch if you want to continue on that narrative. To wrap today's video up, I'm just going to quickly touch on how to go about getting a home equity loan. This is something I had to do a bit of research into understanding a bit better, and I wanted to kind of create a resource that someone might go, okay, these are the steps I need to follow. I can go and do that if someone lays them out for me. Firstly, when looking into doing this process, you're going to want to get an appraisal for your existing properties from the bank. This can be obtained by simply asking your lenders or whatever bank you're planning to go through for an appraisal. Once you have an idea of how much equity you have within your property, any lender, any type of banker, you can go and see them. They're going to run through a series of checks, have a pretty serious conversation with you, because it's a big step. I hope they would have a pretty serious conversation with you where they should be able to lay down everything you need to understand and know about going about this process. And then from there, once you have an idea of how the loan would be structured, once you go out and make a second purchase, they would probably say, all right, now's the time. You understand what you've got, you understand what you're working with. You can now go and make offers on properties up to basically this value. It's essentially getting a loan being backed by your equity. It's kind of exciting because you don't have to save up that deposit as much, but it's something definitely, again, the risks that I talked about in this video are all relevant to that process. To finish today's video, there are two things worth getting stuck into your head when thinking about going down this process. Make sure you understand every single step of this process before signing anything. A 30-year mortgage, if you're using that money to buy another property, is a really long time. Make sure you understand what you're getting yourself into. And number two is to shop around. With interest rates rising, banks are going to have to become more competitive, and there will probably be some relatively good deals. As long as wage growth is following that interest rate rise, you should be able to still get a scalable loan depending on where you're buying within Australia. Just understand that it's important to still shop around to get an idea of what the competition is doing and how worthwhile it is to maybe even jump to a different bank or lender depending on what they're willing to offer you. That's pretty much it. I hope today's video was insightful. I hope you learned something. I hope I was able to educate you on the topic. And if it was, please hit a like and subscribe down below. It really does help the channel grow. I really appreciate the support, and it does not go unnoticed. With that being said, I'll leave you there. Have a good day, have a good week, and as always, I will see you in the next one. Bye for now.